Welcome to Small Practice Support Information Session number 32. In this Law Society of Ireland recording, Michael O'Scahill talks to Justin Purcell about merging or retiring from practice.
Real pleasure just to formally introduce Small Practice Information 32, merging or retiring a practice with Michael O'Scahill from Crow. And we're delighted to have you. If anyone wants to ask a question, please send it in via chat. So welcome, Michael.
Thank you, Justin. Thank you. And good afternoon, everybody. And thank you for the opportunity to speak with you today on these topics, retirement planning and merging your practice. Two topics that are actually interconnected in a way. Might surprise you at first, because I think instinctively we all tend to think of mergers as something maybe that firms that are looking at growth, so younger or dare say more medium-aged firms would look at. But it can also be relevant in the context of retirement, because sometimes the merger can be a spur for a partner or partners who are thinking of retiring to actually take that retirement decision, so they can interlink as well to a degree. And we look at that in our presentation today. I know you had a session back in December with David Rowe where he covers the sale of practices, and that's somewhat related to what we're covering today. And David certainly covered the commercial aspects in great detail. And I think for anyone who hasn't tuned in or attended virtually the presentation, it's probably worth doing so. And even if you have, you might want to go through it again, because as I said, it's covered in good detail there. A lot of those commercial issues are relevant to what we're going to talk about today, and I will touch on them. But I might focus a little bit more on the finance and tax aspects of these areas. Okay. If we start, I suppose, with the retirement side, and what are the commercial issues briefly, and when it comes to retirement planning? And you'd really say that there are two phases to it. You'd have the kind of the pre-retirement aspect, and then the actual execution phase. So in the couple of years building up towards retirement, you need to start thinking about a number of things. Basically, effectively, the first things you need to think about are, how am I actually going to get out? So if you're in a partnership, you have other partners, and quite commonplace, I suppose, with solicitors' practices, you will need to talk to them about the terms and timing and so on of your exit. And in particular, some of the planning points that we're going to look at today, it will require the agreement, the buy-in, the involvement, cooperation, or whatever of your fellow partners. So it's important to talk to them in a timely manner. If you're a sole trader, or indeed if you're in a partnership where you're all going to retire at once and effectively close the business, you're going to have to think about how exactly do you cease effectively. So what are your options? And they're broadly probably four options. You could just simply close the doors. It's the end of the practice and that's it. But even that's not the end of the story, because there'll be legacy issues that will have to be addressed, and there will be a need, for example, to have another solicitor to take over your book of clients and so on. So what you might find yourself doing there is transferring those obligations and those client books and files and so on to another solicitor in return for a fee, which might be contingent or based on the amount of your debtors that he or she can collect post-transfer. So that would be if you had for a simple sale. Most people probably look, though, at getting some value for their practice. So you can look at potentially selling it. Now, there would be maybe two ways of doing that. Traditionally, you would have had what we call the next generation strategy, whereby quite literally in some cases it would move from the parents down to the children, or father to son, or mother to daughter, or so on. Or alternatively, it might be that you have one or two very talented solicitors at a senior level in your practice who are now ready to step into the business owner's shoes, if you like, and go into practice themselves. They can be an obvious target for it. Just as I was saying there to Justin before we went in there, one of the trends maybe in recent years is that the next generation, be it literally family or be it senior management, tend to see a little bit of hesitancy on their part to actually take the plunge, because notwithstanding that, buying a solicitor's practice can be a good business proposition. I think a point that was covered in David's presentation recently, and you're buying yourself a nice income stream and all that sort of thing. That some of maybe the up and coming generation of solicitors are looking at it from a lifestyle point of view and saying, well, look, the obligations involved, in terms of, say, regulatory requirements, long hours, the responsibility, all of that can be quite onerous. And some of them are concluding that the extra income is outweighed by those pressures and obligations. So maybe a little bit of hesitancy on the part of the next generation. So it may not be as easy anymore to kind of transfer from within, if you like, the practice. So you might have to look at a third-party sale as an option. And finally,
just on
then
that
a
point,
topic we'll cover later, the merger.
just
Yeah.
on that point, Michael, just from an outsider's point of view, kind of coming to this more recently, is just how attractive that opportunity to buy an income stream is at a relatively cost-effective price that's fairly guaranteed, as David Rowe was kind of intimating. That really it should be re-looked at, and maybe people haven't thought about it as when you look at what you get as a return from a pension scheme or from stocks and shares or from a return in the bank account. So just for people to look at that again, that there is a revenue profitable income stream to be got at relatively cost effective, and it's protected as in if I'm not a legal person or a qualified solicitor, I can't enter that market to buy that. So
yeah, that's true. Yeah. So then, and again, those kind of next generation things, I suppose, if you could also be relevant if you're selling to a third party, because if you're selling to a third party, the obvious thing to do would be to find another established solicitor's practice to sell to. But it could actually be a case that it's the senior management in other practices who have their eyes out for an opportunity to go into business. They might be potential buyers of your business as well, you know. So another commercial issue you need to think about in the years pre-retirement is what sort of involvement do you want after you sell the business or transfer the business? Are you going to just have a complete clean exit, or are you going to stay involved in some capacity? And this could actually form part of the negotiations as well on the sale, because typically the new purchaser or the new owner will want you to stay involved in some capacity, probably as a consultant for a number of years. You know, and whether that be to help, say, the transition for the clients from you to the new partners or the new solicitors, or in some cases it can be what we call the holding hands function, whereby if someone is stepping up, if you like, to take over your practice, that you're there as a mentor to them for a couple of years. That'll have a financial implication as well, because obviously one of the things you'll negotiate as part of your exit is the salary that you're going to be paid when you become a consultant. You know, so that's an important point. And actually, a side issue here on taxation as well is that when you become a consultant, having been self-employed for many years, some people find it, believe it or not, a bit of a culture shock that they're back on the PAYE system and having tax withheld from their salary every month. You know, we see that at both ends of the spectrum. The young solicitor who becomes a partner, moving from having their tax dealt with every month to having to take responsibility themselves every October, November, that can be quite difficult the first few years, understandably so. But believe it or not, it can actually happen at the other end of the spectrum as well, where somebody who's been in business for 30 years, say, suddenly finds tax being withheld every month. They find that in some cases to be difficult, you know, from a cash flow or whatever, so you need to adjust to that. If you are going to sell the practice, one of the commercial issues, and this will tie in with the financial as well, is there going to be a goodwill value attributed to the business? And then also you'll find yourself during the negotiation phase trying to, you know, when you agree the terms of sale, you might find yourself, for example, having to accept staged payments. So rather than getting full payment up front, it might be paid over, you know, a 2 to 3 year period. And some of the payments might even be contingent on the performance of the practice in that time. So from a tax and financial perspective, more generally, and we've kind of touched on some of them there, but again, you'd almost have the pre-retirement phase and then the execution phase as well. So in those couple of years building up to retirement, what you need to think about quite simply is, well, how am I going to live after I retire? So you'd look at, you know, what are my income requirements going to be and what are my income sources going to be? And the aforementioned consultancy agreement could be a source of income for a couple of years, of course. You have things like state pension as well, maybe to look at if you had any investments, that type of thing. But a big one will obviously be your private pension. And these couple of years leading up to retirement, it's an opportunity there, if at all possible, to contribute and to really beef up your pension. Because remember, somebody in their late 50s can contribute 35%, and that rises to 40% when you hit age 60 of your income to your pension fund every year and get tax relief, subject to there is a maximum contribution of €46,000. But it's an opportunity to tax effectively build your fund over these next couple of years. Then you'd also need to talk to your pension advisor about how exactly you're going to extract or draw down that pension fund on retirement. So You might, for example, take a lump sum, which is typically 25% of the value of the fund, and the first 200,000 of the lump sum is exempt from tax, and the balance is at a special rate of 20%. So it's quite a tax efficient way of getting a nice lump sum on your retirement. And then the balance, the other 75%, would possibly go into an approved retirement fund, an ARF. And normally what you do with an ARF is you would tend to draw down about 5% of the value each year as your kind of your regular income in retirement. Your monthly paycheck, if you like, which will obviously be subject to income tax, but will give you a steady stream of income. So again, you know, if somebody had a pension pot, for example, of 800,000, they'd get a lump sum of 200,000, which would be entirely tax-free, and the other 600 might give them an income of 30,000 euro a year. Obviously, if you go above that 800,000, you know, you're getting an extra 25% of whatever the surplus is as a lump sum, which would be taxed at 20%. And then you're obviously the 75% that's left in the ARF goes up pro rata as well and provides you with extra income. You know, your fund can be worth as much typically as 2 million euro. At the height above that, it becomes very problematic from a tax point of view. But again, look at your funding options there and your drawdown options. And it is advisable to do that a couple of years before you retire. So that's a very important point. Another point to bear in mind, and it might be stating the obvious, but it's worth stating it. Your capital account that you've built up in the practice, that should obviously become repayable to you when you cease. And the drawdown of the capital fund is tax-free because you're effectively giving back to yourself money that you put in. So that can provide a source of cash flow for you as well. The sale of the business, I mentioned goodwill a minute ago, and can you attribute goodwill to it? The vendor, the person who's retiring, loves the idea of goodwill. It obviously increases the value of the business. It's a capital gains tax asset, and it also potentially qualifies for either retirement relief or entrepreneur relief, which we'll look at in more detail in a minute. So potentially could be taxed at a 0 or 10% rate. So clearly the vendor enjoys the thought of goodwill. The purchaser might be a little bit iffy about it because the purchaser will be disappointed to learn, and sometimes surprised, that they can't take a tax deduction for the goodwill against their profits. It's a capital asset, effectively, it's a CGT asset, so they don't get any sort of immediate deduction for that. So often it becomes a pinch point in negotiations. You know, the purchaser wants to attribute more of the price maybe to things like plant and equipment and things that they can get capital allowances on, whilst you, the vendor, might like the idea of goodwill. So they might be you might have to meet halfway on that. So it can be a pinch point in negotiations. A big issue on a sale of or wind up of your practice, commercially as well as commercially as well as financially and tax wise, it would be the business premises. And will they form part of the deal, or will they be sold separately? Because very often, if you're selling to another practitioner, they may have their own premises. They may not necessarily want to buy your premises. So what do you do with them then? Do you sell them on the open market to some third party? Do you hold on to them and rent them out? There'll be tax implications there as well, because if you sell the premises separate to the business, it may well be that the premises wouldn't qualify for some of those reliefs that we've mentioned, retirement relief in particular, if you were to sell them separately. So there might be a bigger CGT cost. So there's certainly plenty to consider there when it comes to property. Other issues to look at there, I mentioned a minute ago that you might have to accept staged payments over a couple of years, or even that some of the consideration would be contingent on how the practice performs. Bear in mind from a CGT and cash flow point of view, however, that the CGT will become payable up front. In other words, you'll be deemed to have sold for the full price, the full maximum achievable price on the day that you sell, and the tax payment accordingly. It's this year's filing deadline and so on, even though the money coming in might be over a 2 or 3 year period. So just plan for that cash flow wise. Then kind of the last 2 points, I think I've covered there the whole issue about the consultancy arrangement and PAYE, the culture shock, if you will. But the last 2 points there are probably very important here, particularly the last one, the cessation basis of assessment. So when you cease practice, you are taxed in your final year only on your profits from the 1st of January to the date that you cease. So this potentially could see a tranche of your profits in your final 12 months of trading drop out, okay, of the tax net. And that might actually influence the timing of your retirement. Okay, so if we look at an example here, it's probably the best way to do it. A very, very simple example. I need to say there's more work involved in this in practice, but say somebody who has a 30th of April year end. So and they decide to retire on the 30th of April 2021. And let's just say they made €100,000 in profits in both April 2020 and April 21. So in April 2020, your 2020 tax return, the normal rule is you get assessed to income tax on your 12 months profits on the date that ends in that year. So 30th of April 2020 profits are all deemed to have been earned in 2020, even though 9 months of it was in 19, or 8 months of it. So you pay your tax on the 100,000, but in 2021, you're taxed only on essentially 4/12 of that, 1 January to 30th of April, which is 33,000. So you have a dropout there of 67,000. So a tax saving. Now, this isn't something maybe you could necessarily plan for to a certain degree, because I mean, your profits are what they are commercially, albeit that some of the points I made in our last session on financial planning about the valuation of WIP and kind of bad debt provisions and that, to a certain extent, can influence the timing of profits and so on. But at the end of the day, you're down to kind of what you're achieving commercially. But what it might do is it might make you pause for thought that if you're having a particularly strong period, and if you think you're kind of at the zenith of your earning, if you will, it can be worth considering, is now the time to retire and get the benefit of a good dropout, because 8/12 of a high figure obviously is better than 8/12 of a low figure, but also it could influence the time of year that you retire, and that typically retiring early in the year might be beneficial as regards to tax treatment. And also you might start looking a couple of years out at things like, what is my accounting year end? Should I actually change it with the view down the line to getting these benefits? So there's a certain amount of planning you can do, notwithstanding that you're still within whatever the commercial reality is, and obviously having to stay within accounting rules and all that, in calculating your profits and so on as well. There's a little bit of planning that can be done there. The point on the post-cessation receipts a minute ago, if when you prepare your final set of accounts, you decide that certain debts aren't collectible, and so you don't realize them as turnover, or you write them off as a bad debt, and subsequently it turns out a couple of years down the line you get a surprise check in the post, they're treated as post-cessation receipts and they're taxed as a one-off event. So not a huge issue with income tax, unlike with companies, because the income tax rate is the same for everyone, but it might have an impact in that it wouldn't fall into your cessation, you're a cessation, so you wouldn't get the dropout on them. They'd be taxed in their entirety. So you might want to think carefully about, are they really bad debts? At the same time, if they are, you don't want to be even paying the 4/12 on them. So that is something that's supposed to bear in mind in conjunction with cessation. The two reliefs I mentioned were retirement relief and entrepreneur relief. Just quickly run through these. So if you sell your practice, it is a business, you could qualify for one of these reliefs. Retirement relief essentially is where you sell business assets. So assets that you have owned for the last 10 years and that you've used in the business. So typically with the solicitor, it will be goodwill, plant and machinery and equipment, office equipment, furniture and so on, and premises potentially. And in simple terms, the way it works is the proceeds up to €750,000, and provided you're over 55, the proceeds of up to €750,000 are exempt. Or if you were to transfer or sell it to your children, it's actually unlimited. There's no upper limit on it from age 55 until you hit 66, at which point they bring in a €3 million limit for the parent and child, and they reduce the third party from 750 to 500. But you want to carefully plan this to make sure that you meet the conditions and that you meet them at the right time. And also around the 750, if you're close to that limit or close to that threshold, and get a little bit messy when you go above it. So there's careful planning required there. An entrepreneur relief is a new relief brought in, I think, in 2016. It's a special 10% rate on the first €1 million of gains. The conditions are a little bit more liberal here. Effectively, you only have to have 3 years of ownership of the assets, and that 3-year period can be any time in the last 5 years. So that potentially might give you a little bit of an opportunity if you were selling some of the business assets separately after the event. Is there a possibility there that if they're sold within 24 months, that they're still within the 5 years? Again, worth considering carefully. And then the interaction between the two reliefs needs to be considered as well. Which one is more favorable to you, more beneficial? You will get the benefit of whichever gives the lower tax bill, but how they interlink requires a good bit of planning as well.
So, Michael, there's a question there. If you're not getting paid for the goodwill, what are you selling? Is it the work in progress or is it the files?
Yeah, your work in progress, and we'll talk about that maybe in more detail when it comes to the merger actually as well. Your work in progress, your collectibles, debtors, and then your office equipment, plant and machinery, and I suppose potentially the premises if they're being sold as part of it as well. But it is effectively your work in progress and your collectibles.
Okay, thank you.
If you look at your commercial rationale, then, sorry, if you look at mergers, rather, beg your pardon, we should move on to here. Before we even look at commercial issues with mergers, let's look at the commercial rationale. Because really, when it comes to a merger, you have to ask yourself the question, why? Why am I merging? What am I looking for out of this merger? And if you can't answer that, you're probably on a hiding to nothing. So you need to have a clearly defined goal as to why you're merging. And also, when you enter into the talks on the merger, both sides need to see quite clearly where the value is going to be generated. It needs to be very clear, identifiable, and very tangible. There's no point kind of if you do this analysis and the two parties conclude, well, the result is going to be the same or no worse off than the sum of the parts. It's not really worth your while doing it. Why would you go through the hassle of merging for that? You need to show there's a clear gain or benefit here. So what in practice are the goals and the benefits that and the value that can be attained from mergers? Well, they can be monetary or non-monetary. I mean, the most obvious one that comes to mind straight away is that great word synergies, so that you can reduce the cost base. And there should be savings there when two firms come together. It should be possible. Things like the administration function, for example, of a joint firm should cost less than two separate firms, or potential savings on premises costs could be another obvious synergy. But as I said the other day when we did this webinar on financial planning, don't just look at costs. You also need to look at the top line, the actual income. Can you generate more business from this? And that should be doable as well, because, for example, two firms coming together, obviously you'll have a bigger firm out of it. That may give you the opportunity to pitch for bigger clients or bigger work that may not necessarily be attainable to you as a smaller practice, which again should boost the turnover. You might be able to go into new markets or new segments. Just from a non-monetary perspective, I guess you might look at things like other specialisms would be a benefit here. So firms that would be you might be eyeing up another firm and they have a particular niche or a specialism in an area that you'd like to get involved in, that you'd actually like from the point of your own professional development and your staff professional development, which could be another benefit to come out of the merger. It could be good for your staff. That can be an attraction to merge. Skill sets in some cases as well, whereby, say, you might feel you have a particular weakness, and you might look at another firm and say, well, the principals in that firm are particularly good at that. So we come together, we can complement each other. I can focus on my strengths. They can handle the areas where I'm maybe struggling on a bit, and it's better for everybody. So, like, for instance, we look at those non-monetary things. An example might be in terms of specialism, say a criminal law practice, for example, might look at another firm that might also be criminal law, but might have a strong, say, admin law function, or kind of in the whole area of human rights, disability, activism, that kind of thing. And they might feel that they tend to complement each other, and they might have an interest in that sector themselves. It's an opportunity for themselves and their staff to get more exposure to that. And in turn, hopefully, that should result ultimately in generating more business. In terms of, say, the skill sets, we've seen cases in the past in mergers where we've had a really successful practice, but the principal, it just literally got too big for them in terms of they're under huge pressure. Maybe they weren't able to devote as much time to their clients because we're having to do things like people management, all that. They saw the opportunity to merge with another firm, therefore, better resources all around, better for everybody, and they were each able to focus on the areas that they were strong on. So so the commercial rationale, as I said, always important there. Commercial issues that come into this, work in progress and the treatment of it. This is absolutely important, and this will touch on the financials and the tax issues as well. So tax and financial issues as well. So if you look at work in progress, I know a lot of solicitors don't like the idea and they tend to skirt over it a little bit. It's different, but it is worth doing. And really, when you're going to merge, you have to, because remember that either you're going to, unless you agree that you're going to literally bill everything and collect it pre-merger, and how practical that is, unless you do that, you're going to bring some of your existing work or your existing files into the new practice, and the new practice is going to bill those. So your new partners are going to share in this. So you want to make sure that you're quite clear on what you're bringing into the new practice and that it's reflected in your capital account. In terms of business premises, this is an obvious area, again, no more than with the sale of practice, but in this case, it's more commercial rather than tax. Because you could, for example, have a scenario whereby you ask, am I moving in with you, or are you moving in with me? Or are we going to a new premises entirely? So then what do we do with our old premises? Do we sell it? Do we rent it out? What if we're leasing it and we're in an onerous lease? Can we sublet it? But what if there's not a long term left on the lease? Would people be interested in leasing from us? So loads of commercial issues around premises there. The other point is, believe it or not, one of the big pinch points in merger negotiations is agreeing the actual effective date of the merger. And that is important for a couple of reasons. I touched it there because, look, from a PR point of view, and this is where it comes into the tax and financial. Okay, from a PR point of view, because it's the big announcement, and obviously for things like transferring your staff across and employment rights and employment contracts and so on, or indeed what payroll are they paid under, naturally that's all very important from a practical point of view. But also it's important financially because that's the date on which you value your WIP. And that's the date at which you decide that you're maybe no longer billing your WIP from your old practice and that instead it's coming into the capital account of your new practice. And the effective date of merger can also impact on the change of accounting date, because if you think about it, the chances are that the two practices that are merging will have different year ends. So you'll have to agree whose year end are we going to take, or are we going to take a different year end entirely, a third year end, if you will. And no more than earlier on when we looked at the vagaries of cessation and how it's treated from a tax point of view, change of accounting date gives rise to special tax treatments as well. And depending on the numbers, depending on which direction the profits are going, depending on the dates involved, you could end up with either two extra profits being taxed or else have a dropout of profits. So clearly it's worthwhile planning around that. And as I said, the date of merger becomes a big thing. The other issue is around accounting date is on the financial side, is on the whole area of your capital account naturally. Because remember, you bring in, how do you bring in? Do you bring in your WIP, debtors, etc., from your existing practice? If you do, that should be reflected as your contribution to the firm, effectively to the new merged firm, into your capital account. An alternative way of building a capital account is you might borrow to finance it. You usually put in cash, and you might have to go down to the bank to do that. Or another way we've seen in practice firms do this is they agree that at the outset that the capital accounts will be low, but there's an agreement or an understanding that the partners they'll go easy over the first years. They'll go easy on the drawings, and they'll allow their profit share to build up effectively and boost the capital account that way. So a lot of issues there on tax financial. One final point I'd make, just coming back to property, just a little tidbit here, or a little tip. You often see that, I think solicitors' practices tend to own maybe their premises more so than some other professions. Maybe it's a little more commonplace. What you'll sometimes find is that the partners who own the property, they might be the same people effectively as the partners that are carrying on the solicitor's practice. So O'Dwyer and O'Sullivan might be the practice, and Mr. O'Dwyer and Mrs. O'Sullivan might happen to own the building as well. Technically, they're two separate assets to a degree, and they might be renting the premises in some cases. So they may not be renting, they might be just treating it as rent-free, that it's all the one. So there's no rent being paid from the practice to the individuals in terms of use of the building. But if you merge and your building is being used, so you merge with Maguire and O'D down the road, you now have effectively four partners using your premises that the two of you own. So maybe you may have to look at charging a market rent at that point. And what are the various implications for that from an income tax and CGT point of view, and even claiming some of the reliefs down the line. So just a practical point to bear in mind there as well. So certainly plenty there, as says, commercially, tax-wise, financially, regulatory to consider. I think, Justin, you might want to have a quick word even about some of the other maybe regulatory stuff and law society assistance and so on.
Yeah, just to say that the business hub is there, and there's lots of really good practical information there with regards to ceasing a practice, closing a practice, buy, sell, merge. The business hub itself, which has got practical information and running a practice. I know there's a question there around the responsibility for runoff insurance with regards to the buyer and the seller and any potential professional negligence issues. I don't have the answer to that question, but we'll send you a link. It'll be on the regulation website with regards to professional indemnity insurance. So that would be available. I wouldn't like to I don't. You don't know the answer to that one, Michael?
No, I know it's after I've no, but I know that
it's quite technical. So
done in terms of the basis of sale. Yeah. Yeah.
So listen, there's been a huge amount covered. We're kind of running out of time. If you just want to move on to the next slide, just there very quickly, we'll just talk about the upcoming sessions that we have. So marketing tips, next week with Claire Fanner from the UK, who's talking about the Law Firm Marketing Club. Jared O'Rourke is going to be talking about developing a paperless office, and then overview of the 9th annual survey of the law firms in Ireland, and then Bank of Ireland finance scheme in the last week. So a full session or schedule of sessions for February. We'll make a recording of the session and send it out later in the week with the slides. If you have any queries at all, you can contact me. My email address is on the next slide. Or if you want to go back and look at any of the other supports webinars, they're available also on the YouTube channel via the small practice information session. So unless anybody has any other questions for us, Michael, do you have anything to say in wrapping up there, or any thoughts, final thoughts on?
Yeah, I mean, I suppose the thing is, I said, it is topical at the moment. The area of mergers in particular, I think, is coming back into focus over the last couple of years. And I think in the context of the last year and COVID-19 and so on, I know we have some way to go on that yet, but I think there's a feeling there that we may actually see some consolidation take place amongst the professions, the legal profession, the accountancy profession indeed as well, that it could be something that's topical over the next year. So that's certainly an area just to familiarize yourself with, I guess. Retirement-wise, the point we'd always make, the big lesson here is, think about it a few years out from this. It's not just those who are thinking that it's going to happen in the next 9 to 12 months, but even those who think maybe over the next 4 to 5 years. Given the various importance of pension, the key tax reliefs that are there, and indeed the commercial aspects that are there, and even in terms of talking to your fellow partners and so on, it's always advisable to think about this a few years out, because retirement may not be imminent, but there might be things that you can do now that will benefit you in 3, 4, 5 years' time when you do retire. So it's always a good time to talk to your accountant and tax advisor, pension people, and so on at this stage. To give yourself that breathing space to get your ducks in a row, so that you can get the best outcome, I suppose.
Well, thank you very much, Michael. Thanks for being such a good sport. I suppose on that note, an old adage I learned when I was in the Scouts: be Olive, be prepared. So a bit of planning and financial planning is always a good idea for everybody. So listen, until next week, Michael, we'll have you on again. Really enjoy having you. I think you give a really, really good show, and I think everybody really enjoyed it today. So you crammed a lot into a very small period of time. So thanks for coming along.
Thank you. Appreciate that, Justin. Thank you.
So to everybody, hopefully we'll see you next week, and we're talking to Claire Fanner from the Law Firm Marketing Club. Okay. On that note, Slán.